Welcome, I'm Catherine Magana here with Greg Carroll, Rachel Ivanovich, and Vince Stefano. And we're here for our weekly discussion on the markets and some planning and investing and just kind of sharing some things that we're seeing out there right now. So I thought I'd kick it off a little differently. We're going to talk a little more about planning this time. This last week I've had a lot of conversations really around beneficiaries. So a lot of people, everybody has, or you should have your primary set up, whether it be a spouse or if you're married or designated somebody as your primary, but it's the contingent beneficiaries that I've been having a lot of discussion on, and just making sure that's set up. So, for example, if something happens to your primary and yourself at the same time, you definitely want to make sure you have a contingent in place, whether it be kids, grandkids, charities, you name it. So just making sure your kind of affairs are in order, and that's definitely top of mind. I've had multiple conversations this week. And so I thought I'd turn it back over to Rachel and I know you're kind of out there looking, it's tax time, and just maybe kind of sharing some ideas here.
That's right, taxes. That's the only thing that's on my mind right now. And I was actually joking to a friend just the other day that this was the first time in years that the Congress didn't pass a huge tax act in December.
Like the 29th or 30th?
Always. And we're like, okay, we don't know what we're doing. So here they go again. On Tuesday, the top tax writers in the House and Senate decided to announced a $78 billion bipartisan tax act proposal. Let's just say it hasn't gone through yet. They're hoping to get it through before tax season starts, which we'll see about that.
I was like, last year they kept changing the dates around too, so.
Absolutely. We'll January 29th is apparently when tax season is supposed to open this year, and the IRS is anticipating it's going to take 21 days to get your refund if you're due a refund. A lot of people say, well, what's a refund? But I'm really looking at this proposed deal it'll be really good, I think, for the markets. It's going to expand innovation and competitiveness with really pro-growth economic policies. A lot of good things for business owners out there. There are several provisions that were part of the Tax Cuts and Jobs Act of 2017 that was passed in December of 17, which have expired, and so this new proposal would reinstate some key business deductions, such as the first one would be research and development, which would be great for companies. The way that the law is written currently, if you have U.S. research and development costs, you have to write that off over 5 years. Mm-hmm. And so this new legislation would allow businesses to write it off in the current year when they spend the money. So I think that would be great for growth. The second thing is that under the Tax Cuts and Jobs Act, what they call bonus depreciation or special depreciation allowance. So it allowed 100% write-off on if you bought a vehicle or equipment, machinery, and so on. So that also was gone. It was reduced to 80% in 2022, and now it hopefully they'll bring it back at 100%. So we're really, really hoping for that for businesses. I think that'll be great. But then, of course, the third thing is this proposal will allow companies to deduct their interest if they do have loans. As we all know, interest rates are high. So if you do have loans, they will be able to deduct that interest. So we're really hoping for that to go through.
And then as right now, we were sharing before we started that, W-2s, 1099s, everything's, the interest, every documents are starting to come in. I mean,
exactly.
For investments, they usually don't come till the middle of February, and everybody starts calling the beginning of January. But the reality is on our end, from investment perspective.
And one of the things we were talking about is, for instance, if you had your investments with TD Ameritrade and then now is Charles Schwab, you need to be looking for 2 1099s versus just the one from Schwab. So make sure if you change, you're looking for 2 1099s or 3. Or, for instance, maybe your lender sold your loan. You're going to have 2 1098s for your mortgage interest.
Yeah.
So make sure you're looking for those, because oftentimes as an advisor, I'll get one and the interest will look really low. Mm-hmm. So make sure you're looking for both of those statements.
I guess the key takeaway is also, get organized, and everything's coming in. And
it's not just that. You have to actually log into your portals these days. It seems that clients aren't getting these in the mail anymore.
Trying to be green. Everything's electronic.
Everything's green. So make sure that you are logging in, that you're looking for the 1098 statements, your 1099. There's usually a tax center that you can access and download those statements.
And I think one other thing with getting all these statements together is everybody wants to, a lot of my clients want to be very proactive about it and get their taxes done early if they get a refund especially, but with investment accounts, there's usually a corrected 1099
Comes March
in
31st.
March. So, always be aware that that's going to be out there. It's not Schwab or TD. It's just a lot of the investments underlying or that they're custodianed at those places. That's, kind of the lag there. So just understand that usually happens every year.
All right, so let's shift a little bit to talk a little bit about the markets. So, gosh, here we are a few weeks into the year, and the markets are pretty much flat or down a little bit. So it's just been an interesting first few weeks of the year. I know we have a long-term view and perspective when we invest, but just kind of keep up, what's happening kind of on the short term as well. And it looks like GDP is supposed to come out next week. There's some forecasts right now that it's supposed to be 2.4. So obviously it's less than last quarter, but just definitely there's some new economic data coming through. And perhaps, Vince, do you want to share a little bit?
It's funny. I was kind of looking at things over the last, 2 weeks of the year, and things have baffled me so far in 2024. First of all, oil prices are at $74 a barrel. And I thought with all going on in the Middle East and the Houthis closing off the Red Sea and bombing ships, that oil would be $100+ a barrel. That has shocked me that it's not. The second thing, home prices continue to stay elevated. I don't know if it's supply, and you could hear about supply, you hear about this, but it's 7.5% interest rates for what, the 30-year mortgage now?
Actually, this came down a little bit.
Oh, it did come down?
It came
Okay.
down. It's at 6.6 was I saw this morning, but in October it was up. It was at 8%.
Yeah,
so that's
and-
a big move in a short period of time.
And I'm surprised. But housing prices have stayed relatively high. Now we're talking, I'm looking at San Diego. I don't know what other parts of the country are like, but still, that's pretty high. Second, retail sales. As I said in one of our earlier talks, I was quite surprised at how retail stocks were doing. Well, it just came out that in the fourth quarter, retail sales were up 0.6% and year over year up 5.6%. So that means the American consumer continues to spend. Now, what does that mean? Well, that means it could be very good for credit cards, i.e. MasterCard, Visa, things like that, and they'll be reporting relatively soon. Banks came out recently. They've done fairly well. They've had some robust earnings. Their net interest rates were pretty solid. And the market, continues to think 6 rate cuts, but I'm seeing stuff from different Fed governors that are saying no, maybe 2, maybe 3, maybe start in the third.
Yeah, no, it's supposed to be in March, and now it's June.
Now,
it's like,
now they're pushing it out to the third quarter, maybe fourth quarter. But the real interesting part of all this is that next week starts the bulk of the earnings season. So the 22nd of January, going really for the next 3 weeks, you will see the majority of companies start reporting. What I'm really looking forward to see is what tech stocks are going to look like, because they have been the horses of the market for the last couple of months. So interested to see what the big boys are going to say. And they'll be coming out relatively soon.
So it's interesting. A lot of calls. We talk to clients, and here we're in Southern California, and a lot of our clients are also on the East Coast and here locally. But one of the things that comes up are how chilly and cold it is, and we're here freezing in California. I hate to say it, but the reality is on the East Coast, gosh, they're really suffering some cold weather. And I was looking at the news this morning and was saying, well, how is that now going to impact retail sales? And I know we were kind of talking about that.
Yeah, energy prices, the whole thing. I mean, that's it's surprising when I see these energy prices still relatively low.
Or how about I don't know if you saw that it looks like Tesla, some of those vehicles, EV vehicles, are having a hard time getting.
They don't perform well at 20 below.
No, it's like, wait a minute.
Charging stations don't even work. There's nothing to pump out of them. So, yeah, there was a news story the other day about Chicago, and it was the Tesla junkyard, but it was a charging, bunch of charging stations, and they were literally had to push some of the cars.
I think I'd be a little upset if I was sitting there in the cold having to wait.
Oh, yeah.
So.
That wouldn't be fun.
But I think these are some things we didn't really plan for or know about, and just now in the future, hopefully finding solutions for some of that.
I think another thing that I did hear, Vince, on credit cards, I think Discover reported yesterday or this morning, and they said they increased their reserves for losses because they think that the consumer is getting a little stretched because they have been spending so well last year that maybe they're building up those credit cards a little bit too much. So it will be interesting as the other credit cards come out and announce their earnings to see.
It's interesting
see if
because Jamie Dimon said something very similar in Davos this week, where he was talking about the consumer being incredibly stretched, how they're oftentimes paying for necessities off their credit card. Credit card interest rates continue to spike a little bit.
Right.
And when you look at the stocks themselves since October, they have done very, very well. But again, living off credit cards is very difficult, and that's not a solution.
Exactly. And even HELOCs, so the home equity line of credits, a lot of people, some people, or if you have it, you want to look at what's your interest rate. Now, when rates were 8% back in October, it's pretty high. But if they're coming down a little bit, it's a little more manageable. But that's something that you have to consider is, okay, if I have those home equity line of credits, am I paying those down? Because they're not the 1-2% that we saw a few years ago, and definitely will catch up to you.
And are all those interest rates on the home equity loans, that's all tax deductible?
Depends on what you spend it on.
You only spend it on tax deductible items.
So home equity. So they, under the Tax Cuts and Jobs Act, again, they changed the mortgage acquisition indebtedness rules. So basically, how much you can deduct on your taxes. So to your point or question, if you have a home equity line of credit, if you use that money to buy, build, or improve your home, then yes, that is tax deductible. Up to, because of course there's new limits on that. It used to be $1 million plus $100,000 for a home equity line. As of Jan 1, 2018, you could only deduct the interest on loans up to $750,000. So loans that were basically grandfathered in pre-12/31/17. But so if you use that money to pay off a credit card, you cannot deduct that interest, unfortunately.
Lots of rules and things you have to pay attention to, and it's always changing too. So, even with
set to sunset at the end of 2025. So we'll see what happens.
That's why we have you.
That's right. You're going to be busy the next year.
Somebody's got to love taxes.
Yeah.
There was my tax question
There
for
you
the
go.
day.
You're welcome.
All right. Well, this was our weekly discussion. If there's anything else anybody else would like to add, otherwise I think that's a wrap for this week.
Please stay tuned for important regulatory disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Wolf Weezy Magana, LLC, doing business as WWM Financial, Savvy Doc Financial Planners, and Savvy Woman Wealth Management, is a registered investment advisor with the SEC.